Welcome to Security Token Stories, brought to you by Security Token Academy, the leading educational platform dedicated to covering and facilitating the security token industry. I'm Derek Edward Schloss, Director of Strategy at Security Token Academy. Coming up on today's podcast, we have Jor Law, attorney and co-founder at Verify Investor. Verify Investor is one of the leading technology firms for verification of accredited investor status as required by federal law. In early 2018, Verify Investor was acquired by security token platform Tzero. Jor enjoys a number of roles within the security token ecosystem, including Director at Prime Trust, Advisor at Polymath Network, and Interim Head of Issuance at Tzero. Jor, it's great to have you on Security Token Stories. This is an episode I've been pretty excited about. There's not many people working within the security token industry that have been studying these problems as long or has seen so many different facets of the intersection of technology and securities laws. Before we jump into security tokens, I'd love to start from your work a few years back and how a new path was carved out in your career when the Jobs Act was signed into law back in 2012.
Great. Yes. Thank you very much for having me on. I had been a corporate and securities attorney with Lex Security, formerly Homeyer Law. And we had always been more active in the alternative finance sector simply because we had smaller clients, more, some of them were grittier clients, some of them were innovative. Many of them had no choice. They had to go toward alternative finance to seek their capital needs. So we had developed a bit of a niche in the industry for being, a law firm that people would go to for angel and venture financing, EB-5 immigration financing, crowdfunding, things like that, right? So what had happened was that the Jobs Act came down, and this was a kind of pretty revolutionary and impactful piece of legislation that affected the market in a sense that it gave a couple of different methods for somebody to be able to generally solicit under certain conditions for a securities capital raise without complying with the full regime of, the securities laws that a normally registered offering would have because they were conducting a public offering. And of course, the Jobs Act had titled, a couple of different titles, Reg CF, the Reg A plus, and kind of the new 506C. And together they really formed the footprint for crowdfunding as we know it today. And it was clear to me simply because of, our practice area and practical kind of experience in the space that Reg A and Reg CF were not going to be the immediate winners out of the gate, and that really it would be 506C that is what people would adopt. So our firm spent a fair amount of resources kind of analyzing 506C, preparing for 506C, and developing resources and expertise to adapt a practice to a 506C market. As part of that, of course, 506C had accredited investor verification. Our firm hadn't found any resource out there that was safe and reliable. So I took it upon myself to effectively create Verify Investor, which was an accredited investor verification platform, to drop down the cost of the accredited investor verifications, improve the safety and security of conducting them, and just otherwise make it a less painful process. As we're all aware now, of course, the accredited investor verification aspect is the most painful aspect of a 506C.
For those that are unfamiliar, Jor, maybe you can spend very briefly just walking through what exactly is an accredited investor under U.S. law, how Verify Investor expedites that process and make that process of verifying accreditation a little bit more seamless and smooth.
Yeah, so an accredited investor is a fairly technical definition that you can easily find out if you probably do an internet search for SEC accredited investor definition. But in a nutshell, there's two or three types of investors, I think, that normally qualify as accredited investors, right? You've got certain types of financial institutions, and they're accredited simply because they're that type of financial institution, right? Like a bank or something like that. Then you've got other types of entities, any entity, LLC, corporations, things like that. And typically, they're going to be sophisticated. They're going to be accredited investors due to some sort of asset tests. They just have X number of assets available, or some sort of sophistication test or something like that, right? And then you've got the natural persons, which are just basically everyday human beings, right? And these are basically individuals or married couples of some sort. And for individuals, they tend to be accredited if they either have high income or if they have high net worth. And, if they're involved with the company that, if they're executive officer of the company that, they're involved in, things like that, right? But in general, you're looking at basically sophisticated institutions, entities with a certain amount of assets, and then individuals or couples that are of high income or high net worth, right? And in the old days, under what is now known as 506B, you would be able to send out a questionnaire and ask people, what their income was, what their net worth was, how they qualified as an accredited investor. And so long as they answered it, and the answers didn't look suspicious, and you didn't have any other reason to think that they wouldn't be accredited investors, you'd probably accept it as is. But with 506C, you actually have to take extra steps to verify that they actually are accredited investors. So therefore, you would, ask for credit statements to confirm liabilities. You would ask for bank statements to confirm assets. You would ask for W-2s or something like that to confirm income, things like that. And as you can imagine, that's scary for an investor to give, and it's expensive to have an attorney conduct that review. Yet the gold standard is that an attorney does it. So what Verify Investor really did to try to drop off the cost was we thought about the practice of law and what made the practice of law expensive, right? And we tried to automate as much of it as we could and try to eliminate the lawyer as much of it as we could, and then bring in the lawyer for the time that really mattered. So if you imagine that you went to a law firm, you'd call up the lawyer, they waste an hour talking to you, they'd send out an engagement letter. Then after they send out the engagement letter, you'd have another hour discussion talking about the definition and how it applies. And then you'd email to them like fairly insecurely information for them to review. They'd print it out on the shared computer, on a shared printer, and the secretary would bring it over to them. And then once they're done, they do the review, which takes them 2 minutes. And then they got to go type up the letter, and all these files going into some paper, record room that everybody at the firm, probably has access to, right? So fairly inefficient, fairly unsafe. So what Verify Investor does is it leverages technology to automate most of that process and provide a secure way for people to transfer files and for reviewers to log on and look at files. And then a lawyer comes on, and all they really do is they spend time conducting the review and making a determination. And everything else is effectively handled by software and automation. And that's what we are. We're basically kind of like an Uber that connects people that need reviews and attorneys that will conduct the reviews.
That's fantastic. Disrupting the practice of law. I love it. So, Jor, you've seen a ton of crowdfunded deals at this point. It's been 6-7 years since the Jobs Act was signed into law. A few questions there. How would you categorize some of the best performing crowdfunded deals over the last few years? And, as you reflect back on the Jobs Act, was this a step in the right direction? Were there some limitations with the Jobs Act that immediately caught your eye or have surfaced and grown over the last, 4 or 5 years? How are you thinking about the Jobs Act today in light of, having the Jobs Act be battle tested over the last half decade?
Yeah. I think the crowdfunding deals that have been successful have often been successful, one of 2 or 3 factors, right? Either the underlying deal has been good, plus they've done some form of marketing that's fairly successful, obviously, or they have compensated with a poor deal by just having extremely good marketing, right? So what you would almost never really see was like a good deal with no marketing getting successfully funded, or a poor deal without marketing getting successfully funded, right? So the most important thing that I think that we saw in terms of success of crowdfunding was the ability to market successfully. And most of the people that came on and thought like, oh, I'm just going to do a 506c and I'm going to go casually market, unless they had an extremely large network of built-in users or fan base, etc., they usually failed. And sometimes they were good deals, just nobody knew about the deals, right? If you think about crowdfunding, the idea is that, if I talk to 10 people and one person is interested in this and will invest, well, then, if I can extrapolate that further and I can talk to 1 million people, then, well, I got many more investors, right? But the problem is you've actually got to go out and talk to all those people. And of course, if you have a built-in deal that's better, it's a little bit easier. But honestly, I think we've seen a number of deals that are not necessarily the best economics, but they've been successful nonetheless. So I don't think that the deal economics is a driving factor. I think it's the marketing. And the marketing has either been that they've had a extremely strong constituent base from which they can begin their marketing with, or they've had a creative and strong marketing campaign to get around that and draw attention. Now, in terms of Jobs Act step in the right direction or not, I certainly think it was in the step in the right direction. I think the securities laws were created in an era where information was not quite so readily available, and it was easy to be cheated, or at least easy to not be able to find information, right? But now, kind of in this information age and digital age, conducting due diligence is a little bit easier, right? You've got internet searches. You can, even do aerial photos. You can hire a freelancer in a local city to go do some research for you. You can pool together with other people from the crowd to effectively kind of recognize that. Immediately, some of the issues that came out were, when I looked at Reg CF, it really, the limits looked a little bit low. The obligations looked a little bit burdensome, and that obviously was an immediate impact to Reg CF. Reg A, I thought, was okay. Tier 1 had all the same issues of why Reg A didn't work in the past. Tier 2 had many improvements, but the dollar amount of Tier 2 being kept at $50 million, ideally that's maybe $150 million, right? And that makes it kind of worthwhile to pursue, I think. But 506c, definitely has immediate benefit. The verification is burdensome and could be eased up on, but there's certainly 506c you've seen has been used the most.
Let's transition over to security tokens and talk through the crowdfunding industry's move into this new disruptive ledger technology. Jor, you were right in the heart of this transition. Why was blockchain tech so interesting to you and the crowdfunding industry as a whole? And did you immediately see the evolution and implications of this hard move to digital as it relates to securities fundraising and the securities industry as a whole?
I think not immediately, right? If I had immediately seen this, I would have gotten into blockchain much earlier and understood it much earlier and started applying to security tokens years ago. What really drew me to security tokens was all the news that was around blockchain and ICOs and things like that. And as I started seeing all our clients kind of start thinking about these things and what other people were doing, I started realizing a lot of applications, including the blockchain, didn't really need the blockchain or didn't make sense. And one of the areas where I thought it definitely made sense was in security tokens, simply because the blockchain provided and decentralized ledger technology effectively provided a more efficient way of tracking securities and bookkeeping, right? And even among private company clients, you certainly see a number of companies where if you go to them today and you put someone on the spot and you say, "Hey, give me your cap table," a lot of them are going to give a cap table that are inaccurate or wrong, or it hasn't been updated or things like that, right? And this is an issue even up to companies like Dole Foods, which, big publicly traded company. They had an issue where, they didn't have quite a strong enough handle on their share count and what was outstanding and what should have been outstanding, right? So this is a problem for everybody that just better accounting makes sense for. The idea that you couldn't transfer these shares if you didn't actually have rights to them, that basic concept is very fundamental to securities transfers, and then there's an immediate benefit there. But because of the greater tracking capabilities, and you also are able to, further, I guess, improve the efficiency of the capital markets and securities and the settlement layer, right? So this idea that, hey, we need a few days to figure out, what's what for us to net and settle things, that concept and the need to do that is diminished. I'm not sure that you needed blockchain to actually get there, but certainly, having a decentralized ledger technology where you could trust multiple parties instead of one party certainly helps make that a little bit more efficient.
These worlds were really forced to collide for you specifically, outside of your natural interest, when Tzero, one of the leading security token trading platforms, acquired Verify Investor. This was early 2018. Verify Investor had probably up until that point done more accreditation investor checks than anyone else in the US, and that probably still holds true today. Is Verify Investor's technology still used by issuers outside of the Tzero ecosystem? Is the tech proprietary to Tzero today? Is it all in-house? And zooming out, why was this acquisition so important for the system that Tzero is building? And how do you expect a Verify Investor to grow over the next few years, whether that's inside Tzero or outside Tzero?
Yeah, certainly. I'd have to start off by saying, I've worked with Tzero and, very closely, but, I don't speak on behalf of Tzero. I don't even speak on behalf of Verify Investor, really, right? So these views are my own. And I'm passionate about this stuff. My world collided through blockchain, through the law firm, through my, work with Prime Trust, through my work with Verify Investor, a whole bunch of different areas, right? But if you think about what the security token world did, and even, not the security token world, but the ICO world, the way of crowdfunding that they used, right? The way of raising capital globally through many, many people, that effectively was crowdfunding. When you combine that with the fact that most of these people, or a large number of these people, were effectively raising investment dollars and issuing out securities, then you're back, at least to the US, but this is true of many jurisdictions, of course, you're back to effectively crowdfunding laws. And Verify Investor was built to comply with crowdfunding laws, specifically Rule 506C. So if you go through security tokens and you look at the aspect of security tokens that makes them interesting, right? Certainly you've got the better accounting and things like that. But for the people that are interested in raising capital through a new method, they're effectively raising capital through crowdfunding. And therefore, Verify Investor and its service is extremely important because the dominant form of crowdfunding effectively is 506C. Now, in terms of our kind of relationship with Tzero, certainly we are used by issuers outside of the Tzero ecosystem. Most of our work is still outside of the Tzero ecosystem, and our technology is not proprietary to Tzero in that sense, right? Like it's Tzero owned and things like that. But the users are certainly not locked into the Tzero ecosystem. That was, I think, important for Verify Investor to be able to service the world, and also Tzero, right? Tzero's view, I think, has been that while they've been building proprietary software and technology for themselves, they've actually been a champion for the industry, and have openly kind of formed partnerships to support other people and things like that, right? So having Verify Investor effectively be a service that the entire industry can use, I think is something that Verify Investor has liked, and I think Tzero enjoys as well. The acquisition is important. Who knows why people make acquisitions and things like that. Different management teams at Tzero may have thought of different reasons why Verify Investor is important. But if you look at the security token ecosystem, it's fairly fragmented, right? There's a bunch of people doing primary issuance, there's a bunch of people doing secondary market, and there's certainly front runners in a space. For example, like Tzero is probably the front runner in the secondary market space, but no one has like such a clear dominance that.
We're still early. We're still fairly early.
Yeah. Exactly. And if you're looking at the funnel for security tokens, if you believe that most security tokens are going to be crowdfunded, and most crowdfunded tokens are going to be Rule 506C, then if Verify Investor effectively is the dominant, not just like a little bit more active, but if we truly were like by extremely dominant, as most people think we were, then we become that one part where I think there is a little bit of a funnel. And it's not so much to control the funnel, but I think it's an opportunity to educate issuers that there's this entire ecosystem out there. If you're thinking of crowdfunding, then maybe you would see other synergies with the Tzero ecosystem, and vice versa. If Tzero was to separately pay Verify Investor for all the deals that they plan to run through their ecosystem, it would get quite expensive, over a period of time. So I think it was strategic, but that could be me, drinking the Kool-Aid and kind of justifying why we sold it. But presumably, Tzero saw some value for similar reasons.
Yeah, I think that funnel that you mentioned makes a lot of sense to me. You've been helping Tzero build out the beginning part of that funnel as head of issuance. What were some of your responsibilities there, and how were you thinking about integrating these two components together, primary issuance and downstream secondary trading?
Yeah, so I was very fortunate to be retained by Tzero as a consultant to help build their issuance department as their head of issuance. I would call it interim head of issuance because it was always intended to be kind of a short-term engagement to accelerate the launch of the issuance department. And they have a fantastic head of issuance that I'm really excited about now, Brooke. You cannot have a strong secondary market if the ecosystem doesn't have primary markets, right? It just is an impossibility. So I think Tzero it's important for Tzero probably to have a vast network of partners, et cetera, in the primary market. But there are certainly no shortage of people that came directly to Tzero asking, if can we just work with you? All we know that we want to end up on, your affiliated ATSs or exchanges, et cetera. We don't really want to work with other people. Don't point us in a different direction. Why? Just help us, right? And to help address those types of clients, Tzero thought, hey, we should introduce primary issuance capabilities. We know how to do this. We've done it, once for Overstock already. We've done it once for ourselves. We've done a good job doing these things. Maybe we could share some of our resources and knowledge with other people, right? And then certainly for most of these folks, they would still kind of work with other partners in the space. So I think that was the genesis of the issuance department. I'm not sure. I came in kind of after the decision had been made to go build this, and effectively, it was everything. It was making sure that the product was good, building out good internal product, forming great partnerships for anything that we didn't house in house. Making sure that the team to operate the issuance team was built properly and things like that. Putting in great systems and things like that. So those were some of the responsibilities we had there. It was easy to work with Tzero because they had the resources and they had the platform and they had the capability to effectively build something extremely quickly. And I think I was able to launch, along with my brother, who was co-head of issuance with me, the business in just a few months. In terms of integrating Verify Investor and Tzero, I think one of the beauties of Tzero and one of the reasons I think they are a front runner is they've got some resources that most other people don't have. They've got vision that I think a lot of people don't have, and then they've also got network, right? They've got network because they've got a vast reach among the ecosystem, hands in many pies. They're also a player in the existing capital markets, right? So if they can find a way to kind of combine this entire network and ecosystem together, I think that network effect would be extremely helpful. And issuance is just a piece of that.
So, Jor, I'm just gonna list a couple of your titles over the last few years. You've been founder of Verify Investor, director of Prime Trust, Polymath Network Advisor, Tzero head of issuance. All of these roles touch on important aspects of the security token industry. We have identity and custody, issuance, lifecycle compliance, optimizing a token's path toward downstream trading and secondary markets. I mentioned this earlier, but one of the reasons I'm excited to speak with you, Jor, you're seeing this industry come together in a way that I don't think many others are. So I have to ask, where is the industry today? What are the bottlenecks you're seeing on the ground floor? What looks good? What needs refining?
The industry today is certainly early, right? It's still anybody's game. Mistakes will still be made and things like that. But where the industry is today is dramatically ahead of where it was, even just a year or two ago. You certainly see companies that have moved, right? Before security tokens was this concept and it was idea and it was a marketing gimmick. It was all these people that were doing ICOs and they suddenly said, hey, we're going to be STOs because, well, one, the SEC forced us to, and two, it's the cool thing, right? But if you fast forward to today, you've got version 1.0 of the technology out, right? You've got version 1.0 and the early entrants into the regulated licensed activities. Those players have gotten their licenses. They're open for business, right? That wasn't true a year ago, right? So while it's in its infancy, the industry today is at least an industry where you can play, right? Like if you're thinking about, I don't know how many of you guys are poker players, but if you're thinking about you want to go to play poker and you've got a number of people that want to go play poker and then you go to a poker room, but there's no table, right? You've got to wait. You got to wait till enough people come and sit down at that table. And then once you've got a few people sitting down at the table, you can begin the game, but it's not a complete game. And then you start playing, and as you start playing, then additional people come, you fill out your table, you build out new additional tables, and now you've got an ecosystem going that can last for, a extended duration, right? So I think that's where we are today, right? We're in fairly early. A number of people have sat down. They've started becoming playing. They started playing. A bunch of other people are now forming this crowd, looking about and saying like, "Oh, this is interesting. I want to play too." And some of them are signing up, sitting down. They want to play too. What you're starting to see also is not only are the original players playing, but they're also improving, right? They're starting to figure out where they maybe made some mistakes early on, or maybe where they can improve their technology now. And now you're starting to get this new crop of existing players that are improving their technology to, let's say, a version 2.0 or 3.0. And then you're also getting new players coming in and saying, hey, we're going to create something new because we think we can improve on what version 1 has already done, right? So that's really, really interesting. One of the big bottlenecks, of course, is that you can have all the product in the world, but until you've got deals running through, it doesn't really matter, right? And on that front, I think things are positive as well because you're starting to get more deal flow running through the ecosystem across all the players, right? Instead of people working, before it was an achievement to do a couple deals a quarter. Now it's, the people are trying to do dozens of deals a quarter, right? The other thing I think that is important is because securities only make sense when they're quality, right? Like this is a supply and demand thing. If the supply is poor, of poor quality, then the demand will be of poor quality, and which means there will be no demand, right? So at some point, the securities world the STO world will have to move from being a space where most of the deals are just mediocre or bad to a space where you'll get bad, mediocre, and great deals. And I think on that front too, we've made progress simply because a lot of higher quality issuers and higher quality financial institutions are moving toward STOs. And I think in the next year, you'll start seeing the average quality increase. And that's important for the ecosystem, I think.
I wrote a piece this summer called Security Tokens in the Investment Stage. And I argued that, you really need these three categories. You need, quality deal flow, you need regulatory investments, and you need infrastructure investments to really come together. I'm kicking myself right now for not thinking of an analogy as good as that poker table one. So blockchains are a ledger database innovation, Jor. When you're thinking about how this industry will scale over time, how do you think about the best types of blockchains, these ledgers, these databases that people will eventually tokenize on? You've already seen a crop of these first-gen blockchains. Ethereum, Stellar, Tezos, EOS, these are the chains that people are using to tokenize their securities on today. Are these going to be the blockchains that security tokens live on in the future? What are the limitations you're seeing here? Is there a generation 2.0 of blockchains that are better tailored for this use case? And do you think that we're going to tokenize equally across many chains in the future, or is there going to be power law dynamics at play here? Like there's going to be one security token blockchain that everyone flocks to?
Yeah, this is interesting. There's no question that today it's Ethereum simply because they've already got the network. They've already got a bunch of people that understand their technology. Almost all the major players support it. Even if they support something else, they, almost all of them support Ethereum. Stellar, Tezos, EOS, they certainly offer some interesting improvements or alternatives to Ethereum, but it's hard to say where they will be, right? Stellar had a big push in security tokens maybe a year and a half ago, and then it seems like they lost a little bit of steam there. Tezos, on the other hand, recently coming up. Right? I know it's on everybody's radar, but whether that's just kind of a push in marketing or kind of a long-term kind of sustainable push because the technology is there, who knows, right? EOS is just this marketing madhouse and machine. It's hard to distinguish between what is like
the hype and the reality.
Yeah, there's a lot of people hyping it because they've got interest in hyping it. It'll be curious to see, whether it emerges as kind of a technology, a backbone for technology. And certainly the promises of EOS are pretty amazing. And when you start thinking about chains and how they're important, and I've been doing a lot of this, thinking around this because, I've talked to, I'm friends with the founders of Onera who are developing their own blockchain. I'm very close with the Gibraltar Stock Exchange team that have developed kind of the Stacks ecosystem and chain. I'm working directly with Polymath and working on and developing their Polymesh chain. So when I think about what you need for a chain, ideally it touches upon identity in a way that makes sense, in a regulated manner that makes sense, because most of these other chains do not have adequate identity solutions. And then ideally, you can handle confidential transactions in a way where they're free flowing. You can easily take advantage of both a public chain as well as take advantage of confidential transactions and information and things like that. Ideally, the scalability of the chain and the transaction output of the chain are quite high. Things like that, right? And the flexibility of the chain to be able to handle multiple types of, jurisdictions and treatments of security tokens, and not just security tokens, but derivative versions of that, right? Like if you've got this entire market that trades on top of security tokens, like the second layer of securities, ideally your chain supports all that activity as well, as opposed to just the primary kind of activity of I buy a stock and I sell a stock, right? What about derivatives and all these things, right? So ideally a chain addresses all of those things and some more. Obviously, very complicated things. I'm not sure that anyone is going to get the first time correct, and hopefully they've got architecture that's upgradable, that will kind of be able to adapt to changing technology, changing views on regulations, and just new ways of doing business.
I'm happy you mentioned the Gibraltar Stock Exchange. I had a great conversation with Nick, the CEO of GSX Group, a few episodes back, and we walked through the GSX Group's network token, the Stacks token, which powers parts of the GSX ecosystem, including staking on the Stacks blockchain. It's a medium of exchange for transactions in the ecosystem. I think with the Stacks token, you have things like early access rights, fee discounts, voting rights. There's also a number of other security token focused projects in the space that have these utility features that are built in to tokens to help align incentives across the network. One of the interesting things for me is watching this intersection happen. Do you have any insight for how these utility tokens, these network tokens, might interplay with security tokens or even security laws more generally in the future?
Honestly, this is anybody's guess, right? You had this whole ecosystem where a lot of people did these things and they didn't really fully understand utility versus security. They thought it was actually one versus the other when really it wasn't one versus the other, right? It was, do you have utility? Are you a security, right?
Right.
And you saw not just, companies doing this, technologists that had no idea of what law was. Not only were they confused, but the top lawyers at the top law firms were confused. And honestly, I think the regulators were confused for a period of time, right? So it was a new area where that stuff wasn't clear. But what is pretty much clear is that if you do have a blockchain, there's some sort of token that powers that blockchain. And that's true of every chain pretty much, right?
Right.
And to the extent that that's true, then it's not like if you're on Ethereum and you don't have a utility token for your securities offering, that there's no utility token. There is one. It just happens to be Ethereum, right? So for all the folks that kind of, there have been a lot of companies that have been very critical against other companies for having a utility token tied to their service offering and things like that. And sometimes they make good points, sometimes they don't make good points, I think. But what is clear is that there's almost always going to be some sort of mechanism to enforce this blockchain that's tied to some sort of token, right? And in that respect, I think that thinking of how tokens are used and implemented is important for the health of that blockchain, right? If the utility tokens don't make sense, then the miners don't go on and mine and confirm transactions, and validators don't go on, and the health and wellness of that entire chain becomes a threat, right? So I think when you start thinking about these things, I think of them in that perspective, right? Not so much in a regulated perspective, like, oh, is this good for business or not? But just thinking like practically what needs to happen for infrastructure to be healthy. And then after that, obviously you could think about securities and things like that. Certainly, a utility token should be treated as a utility token, right? Not a security token and things like that. But I think this question for me is one more of, how can we have a healthy ecosystem, so that the token is either integral to the use of the chain, or even if it's a payments token, that it's a worthwhile payments, utility token.
Yeah, I agree with that framing, Jor. Switching back over to accreditation, are accredited investor checks, here in the US doing what the Jobs Act intended in terms of protecting investors? And if not, what would you change about our accreditation laws in the US now that we've had sufficient amount of time to see them kind of work through the system?
Yeah. I've been vocal about this, and these are definitely my personal views. Definitely not the views of Verify Investor or Tzero, or if they were, that I'm not sure that they would admit it. Look, I am not positive that it is protecting investors significantly. I'm sure there are some investors that are protected. I guess if you had someone that really wasn't an accredited investor and wanted to lie about it, and you wanted to protect that person, they were really just either lying or extremely clueless and being taken advantage of. Maybe you take advantage of that and protect that investor. But I think it seems to me that those investors are few and far between, and it doesn't seem that the method of which verification is used makes sense. It's to me, it introduces far more risk than it does protection, right? So if you imagine that you're a good issuer and I'm a good investor, right? And these are the people we want to protect, right? We want to protect good issuers. We want to protect good investors. So a good issuer goes out and does the right thing, and a good investor doesn't lie and says, hey, I really am an accredited investor or not. And they do business. If you verify them, then you've just verified a completely good deal, and you've introduced all this burden into that deal, and then you've increased the risk of identity theft and information leakage and things like that because of the information that the investor was forced to give and the issuer was forced to collect, right? So you've harmed good people in that case. Now let's think about the bad case, right? You've got a good issuer and then a bad investor, right? If you got a good issuer and a bad investor, the bad investor is going to lie. Should we protect someone that lies? I would argue no, but let's say we want to. If they lie and they start doctoring information, then they get past the verification laws anyway. And the good issuer has the right, sort of funny business to kind of, take it at face value, some of the information that they collect. So does that protect good people? No. Did it really stop the bad people? Maybe a little bit, but not really. And then you look at bad issuers and any sort of investor, and bad issuers have like a free pass from the government to collect all this information. And heck, if somebody was going to cheat me before, now they're going to have all this extra information to cheat me with. The SEC did kind of have a proposal out there that they think about how securities laws are and how they can harmonize it. And I did submit some letters on that.
I was going to ask. I'm happy you did. I think they would probably appreciate hearing from you.
Yeah, they weren't popular opinions, of course. But one of the things I thought was that if the idea of accreditation is to protect people, right? You've got that on one hand. And then you've got also this new emerging economy where, this divide between the haves and the have-nots are becoming a little bit more apparent, right? And certainly a number of have-nots have effectively said, well, why can the haves, why do they get to invest and we don't get to invest, right? So I believe that maybe there's a way that you can have a little bit of both, right? Maybe you keep the things like general solicitation and the benefits of general solicitation. Maybe you keep those benefits for everybody. Today, if you look at 506C, who benefits from general solicitation? Companies, yes, but look at the investors. Accredited investors uniquely benefit from general solicitation under the Jobs Act, basically, right? Like or for 506C. They benefit more than anybody else does. The non-accredited investor benefits a little bit under, Reg CF and Reg A+, and the 506C, they're cut out completely, right? So you've got this technological, and you've got this fundamental shift in how information is available and how you can find information, and that's a technology that all of us enjoy equally. But you've got now 506C that says, oh, wait, hold it. Even though you have all the benefits of and all the extra information from 506C, you can't do it because of this rule, right? So I think some of that is unfair. I've got some ideas for how one might modify 506C to make it a little bit more fair for the have-nots, while still kind of staying true to the mission of what we believe people who are accredited are either richer or more sophisticated, and therefore they need less protection, right? I think I found something that is a little bit of a middle ground.
Outside of investor accreditation, is there anything else you might change in these regs to facilitate this new security token paradigm? So whether that's increasing capital raise amounts for Reg CF from $1 million to $10 million, or Reg A plus to $100 million, so that the administrative burdens don't cut as bad for new issuers. I guess, how are you thinking about the regulatory side of security tokens really scaling with this new technology? Is there anything else that you've got your eye on?
Yeah, if you were looking at just each one by themselves, I think increasing the limits for Reg CF to be something where the burden of complying with the laws are proportional to the amount of money that you raise would certainly be helpful. I don't know what that would be. So for Reg CF, maybe I would ease some of the burdens, and I would definitely want to raise the limit. For Reg A plus, similar, but I think a lot of the burdens make some sort of sense to me. But certainly raising it to $100 or $150 million makes it very interesting, right? Because then it's clearly big enough to be worth doing that. Otherwise, you get some people, and look at Reg A and they're like, it's too burdensome for me, to do at 50.
Right.
And, by the time I do all this, well, maybe, I might as well just go and be a registered company. One of my solution, which would be let general solicitation of 506C maintain, probably kill out the verification element and introduce, like a different element, like a very clear statement, explaining that, these deals are risky no matter what. You must be an accredited investor. If you're not an accredited investor, you'd be lying, trouble, whatever it is, right? Come up with some sort of standard disclosure and standard representation that people make. And then I would actually advocate allowing everybody, accredited and non-accredited investors, to invest in deals. And then maybe if you were not accredited, you would tie it to a percentage of accredited investor, investors, and or maybe caps on investment amounts, right? Therefore, kind of if the logic was like, well, accredited investors know what they're doing, they can protect themselves, then the idea would be like, well, maybe non-accredited investors can piggyback. And if the idea was that, well, accredited investors can afford to lose money, then maybe you say that, well, we're going to do some investment caps to deal with that on the other end. It's not perfect. Certainly, for example, I fully understand that 10% of someone that makes $20,000 is different, very different from 10% that someone that makes $10 billion. But, all of these things are kind of compromises, right? You look at how many people you can protect while efficiently promoting capital markets. And I think that's one potential solution to revamp 506B and 506C, harmonize them. To do this, I've released a comment letter to the SEC with more details on the proposal. And I think if you do that properly, you might not even need Reg CF. You might not need Reg A+. Who knows?
This has been great. I've really enjoyed this conversation and learning more about Verify Investor, your roles at Tzero and Polymath and others, and especially how you're thinking about these really unique problems. Let's keep in touch, and I'll get you back on the podcast again soon.
All right. Sounds good. Thank you for having me on again.
That's it for this week's episode of Security Token Stories. For more security token content, visit us online at securitytokenacademy.com and subscribe to our newsletter, The Security Token Edge, which lands in your mailbox each weekend. You can also keep up with the latest security token news by following us on Twitter, Telegram, YouTube, Facebook, and Medium. Before we go, a big thank you to Security Token Academy's Platinum and Gold corporate members who make this podcast possible. You can learn more about Security Token Academy's corporate members at securitytokenacademy.com. I'm Derek Edward Schloss. From all of us here at Security Token Academy, thanks for listening.
Security Token Academy does not provide investment or legal advice. We are not a registered broker-dealer or investment advisor. Opinions expressed in this podcast are the speaker's own and do not necessarily reflect the views of Security Token Academy. More information can be found on our website at securitytokenacademy.com.